If you have access to a health savings account and you're not maxing it out, you are leaving free money on the table. And I mean that literally, because the HSA is the only account in the entire U.S. tax code with a triple tax advantage. Let's break down exactly how it works with real 2026 numbers so you can see what this is actually worth to you. Here's the triple advantage. First, your contributions are tax deductible. Money goes in pre-tax, which lowers your taxable income the same way a 401k contribution does. Second, the money grows completely tax-free while it's invested inside the account. And third, withdrawals are tax-free too, as long as you're spending them on qualified medical expenses. No other account gives you all three. A 401k gives you the deduction and the growth, but you pay tax on withdrawals. A Roth IRA gives you tax-free growth and tax-free withdrawals, but you fund it with after-tax money. The HSA is the only account where the government doesn't touch your money at any point in the process. For 2026, the contribution limits are $4,400 if you have self-only high-deductible health coverage and $8,300 for family coverage. If you're 55 or older, you can add an extra $1,000 catch-up contribution on top of that. To even qualify, you need to be enrolled in what's called a high-deductible health plan. Check your plan documents because not every high-deductible plan on paper actually qualifies under IRS rules. Now here's the part almost nobody talks about, the stealth retirement strategy. You are not required to reimburse yourself for a medical expense in the same year it happens. You can pay out of pocket today, save the receipt, and reimburse yourself from the HSA 10, 20, even 30 years later, completely tax-free no matter how much the account has grown in the meantime. That means if you pay a $200 medical bill out of pocket this year and invest that $200 inside your HSA instead of pulling it out, by the time you're ready to retire, that $200 could have grown into $800 or more, and you can pull the entire amount out tax-free by matching it against that old receipt. Most people treat their HSA like a checking account for copays. The smart move is to treat it like an investment account and pay small medical bills out of pocket whenever you can afford to. Quick comparison to the FSA, since people confuse the two constantly. An FSA is generally use it or lose it within the plan year, tied to your employer, and doesn't roll over or invest the same way the HSA does. The HSA is yours for life. It stays with you even if you change jobs or leave the workforce, and every major HSA provider lets you invest a balance above a certain threshold into index funds similar to a brokerage account. And here's what happens at age 65. Once you turn 65, the rules loosen up significantly. You can withdraw HSA funds for any reason at all, not just medical expenses, and you'll only pay ordinary income tax on the withdrawal, exactly like a traditional 401k, no penalty. That effectively turns your HSA into a backup retirement account with an added bonus. If you do use it for qualified medical expenses, which become extremely common in retirement, that portion stays completely tax-free forever.
A few common mistakes to avoid. Don't let your HSA sit in cash, earning almost nothing if your provider offers an investment option. Check the account settings because many defaults keep new contributions in a cash sweep. Don't use it as your everyday spending account if you can afford to pay small bills from your regular checking account instead. And don't forget to actually keep your medical receipts. A simple folder or spreadsheet works fine because you'll need documentation if you're ever reimbursing yourself years down the line. To recap, the HSA gives you a deduction going in, tax-free growth while it's invested, and tax-free withdrawals for medical expenses, plus a stealth retirement account if you play the long game with your receipts. If your employer offers a high-deductible health plan with HSA eligibility, this is one of the highest leverage accounts available to you in 2026. This is educational content, not financial or tax advice. Talk to a qualified professional about your specific situation. If this helped, subscribe for more personal finance breakdowns every week.